Cool. Good afternoon, everybody. My name's Alvin. I'm from Consulting Services. I'm going to take you through a quick intro and then hand over to Kim, who is our Ifrs JSE advisor guru. Big passion for Ifrs SMEs. So, like I said, I'm from the Consulting Services arm. Um, I do a lot of compilations of financial statements for using DraftWorks for Ifrs SME clients, full Ifrs clients, annual reports on it for certain 4AX clients. I work with JSE clients as well. Um, Overall, today we're going to take you through a bit of the anticipated changes for Ifrs for SMEs. We're going to look at some Ifrs 16 and lease issues, and then also feedback from the JSE. What I want to urge you is, even if you only do Ifrs for SMEs, stay for the entire webinar and presentation. The leases is anticipated to what's coming in future so that you get a bit of an idea of the impact in future for your financials. And then also on the feedback from the JSE, please, that's not only aimed at listed clients, specifically for listed, but there is a section on, for example, fair values and going concerns that we're going to look at, which is applicable to us all, especially with COVID and the current day and age. Going concern, hot topic for disclosure in financials. As all said, if you need a certificate for CPD, you'll send an attendance. You're more than welcome to email me and Kim as well if you need a specific one, and we'll get that through to you. I'm going to be monitoring the Q&A function throughout. If there's questions, please type it in there. I'll stop Kim and then we'll discuss that question. Otherwise, I'm keeping a list of it. We'll quickly touch base during the break and then give you feedback all specifically on it. If it's items I can answer directly, I'll do that as well. And then overall, look out for your emails or in the webinar. I'm quickly going to send the documents to all. There's 2 or 3 documents that we want to share with you guys, especially the slides. Then you can make notes as you go along. Please just don't take the slides and go. You'll see it's not going to help. The training is very interactive, so you'll see with Kim as well. That's why you're seeing this funny screen that she's sharing. She's going to highlight right, and yeah, the slides is going to look completely different once she's done with it, filtering in Ifrs magic. So I'm going to hand over to Kim. Please enjoy the session with us. And yes, thanks, Kim.
Thanks, Al. Yeah, good afternoon, everyone. As Al said, it's chilly. It doesn't begin to describe, I suppose, for most of us in the Josie area. I don't know where else we're all dialing in from, but it is prison. Thank you for making the time. We are, as Al said, we are going to be discussing overall 3 major things. Ifrs for SMEs, what are the changes as a result of the second comprehensive review? We're going to have a look at some Ifrs 16 nuances. And then lastly, that JSE proactive monitoring process. I just want to emphasize what Alvin also said is please do stay online. The issues that we're addressing both from Ifrs 16 as well as the JSE's proactive monitoring review might seem onerous to really listed entities or those obviously applying full IFRS. But you'll see the reason why I put IFRS for SMEs first is because of the very changes that might actually incorporate some of the topics that we've included in the second and third section. We will, as we also mentioned, we will break around 3 o'clock for a 5 or 10 minute coffee break, just warm up the fingers and get some movement going. Other than that, we are obviously, Alvin said he will be dealing with getting the slides to you now. Don't stress about not getting them. We will make sure that you do get a copy. For the time being, obviously, as I do the intro and just start perhaps on some Ifrs for SMEs aspects, apologies that you don't have them with you yet. I am also going to switch my camera off in a second. I know that there's some issues around whether that's considered ethical or not. I know everyone's like, well, let's all log on. I think it's only better that I see you. And it's also for me, it's a little bit of a distraction to constantly continue to make eye contact, especially when I'm going to be writing the board. So you'll see the top of my head as opposed to my face more than anything in any event. So I'm going to switch off in a moment. If you do have any questions, please pop them. As Al said, he will be monitoring the Q&A. If there's anything that is relevant to bring up, he'll obviously interrupt me as necessary. Alternatively, we can deal with anything offline afterward. I will be including both of our email IDs if you would like to make contact with us. And as Al said, far-reaching changes coming up. How far, we don't know. Good news, well, that depends on whose shoes you're sitting. So please do enjoy with us for the afternoon. Appreciate your participation. And any comments are welcome, especially with regards to this Ifrs for SME section. We're going to see some differing views, no doubt. So here we go. Without further ado, I will switch on a little bit later to say goodbye, but for now, let's go to these slides. Right, so there are our details. You are more than welcome to email either myself or Alvin directly. Obviously, Earl also and all of his team do have our contact details if you do need to get hold of us for any reason. What will we be discussing today? As already mentioned, 3 main sections. The second comprehensive review of Ifrs for SMEs. This standard, ladies and gents, obviously built on Ifrs quite a good few years ago, has been in the realm for about 6 or so years. And this second comprehensive review is far more encompassing than the first review was. The first review was really, let's do a few things, but let's not overwhelm. It's only been in existence for a short period of time, etc. So a lot of the changes that likely could have happened at the time of the first review didn't. And that was for a variety of different reasons that the board does address in their intro for the second comprehensive review. However, we're now sitting with a lot of sections that are being looked at. We'll talk more about the dates, etc., and what is actually on the table. For now, I just want to mention that we do not yet have an exposure draft. So you might say, okay, well, at what point in the process are we? Really, what we had last year was what they call a request for information, and that was open for comment until the end of October 2020. And then from where that comment period closed up until the end of December 2020, the ISB then issued what they've really just summarized all of the feedback that they have received. So we've got this feedback document, and then based on all the feedback and the responses, obviously, in regard to the questions that were posed in the request for information document, is now going to be put together with an ED. Not only do we not yet have one, and we're now in June, but there's also no date. I just confirmed before we started, I checked the ISB's website, and where they've got the work plan, they normally would propose, or they give whatever the proposed date is for any exposure draft to be issued, and we are not yet there. So interesting, because I did find a document that suggested that we would have an exposure draft by March 2021. But again, I think the ISB has got a fair amount on their plate, this being one of probably their bigger projects, but nonetheless, obviously being a bit of a balanced situation. So we'll wait and see when that does come out. I think the exposure draft, between exposure draft and actually finalizing, is again, how long is a piece of string? So there really is no timeline either. But I would like to caution that as soon as we do have the exposure draft being published, there will be another comment period. And those constituents that have a view, that have something that they want to say, should most definitely incorporate these points of view in a comment letter. I know that generally we've got audit firms that present these comments. I think it's from an audit firm point of view, it's generally one comment letter, I think, per global firm, if I remember correctly. But nonetheless, anyone and everyone is entitled to prepare or present any of their views, comments, or questions. Obviously, making sure that the comment letter does address all the questions that are indeed posed by the ISB in the relevant exposure draft. On Ifrs 16, we're going to look at some practical issues. Now, practical, not in the sense of we're not proposing that everything that we've experienced over the last year or so, from transition to where we are now, is going to be applicable. I mean, we've had some really weird and wonderful leases crawl out of the woodwork. And as a result of, I don't know really if we can blame everything on COVID, but a lot of entities have renegotiated their leases, or we've seen them receive the rent concession under IFRS 16's amendment. But there really has been a lot occur post-transition. So for those of us that thought we're home Jerome, having moved from IS 17 to Ifrs 16, well, yeah, that's not been the case at all. I think Alvin and I have been more busy with leases over the last 12 months than what I think I've been in almost all of my career. So IFRS 16 and its nuances posing perhaps a bit of finickiness. Alvin and I have also put together quite a bit of guidance for ourselves, but none of it really is, we've realized, none of it is a fits-all situation. You really have to go and assess each lease on its own merit because of what can or can't be interpreted as being, for example, a reassessment versus a modification. I'll stop there, otherwise I'm going to get ahead of myself in terms of the topic. With regards to the proactive monitoring reports for 2021, I've called it 2021, but it really is in lieu of the reviews of 2020. So my bad, I suppose, in saying that it was actually issued in Feb 2021, but it is in light of all of the 2020 reviews that the JSE performed. I really want to mention their highlights more than anything else. And what I did do was they recently held a webinar where they addressed their report back. And I've hijacked a couple of their thoughts and their shares that they had with the audience back then in May, and I will be sharing those with you. So from that perspective, I do want to stress that I have got some images, etc., that were from the JSE's webinar. Not that I've reinvented the wheel, but instead that I just tried to keep it as straightforward as possible. So if you were indeed part of that webinar, I think it was the 10th of May, you might see some copy and paste from that perspective. Right, without further ado, Al, can you just confirm whether we have been able to send out, or Earl for that matter, but Al, have we been able to send out the documents? Does everyone have yet?
I'm busy with that now, Kim.
Okay, super. Thanks. Also, for those of you, please do stay tuned. You will get it. There's really nothing that I think you need to make massive notes on. If you do want to make notes in the meantime, you can obviously just write down the slide number and make a note on the side. Apologies for not getting that out sooner. Yeah?
Sorry, Kim, I think with that, Kim saved her slides with all her scribbles and notes on it as well. We will have that at the end of the session to distribute as well.
Thanks for that, Al. Yes, absolutely. So I do save whatever I've written, whatever I've scribbled. I save it into PDF, and that is distributed by all in the team. Subsequent, I know there's also a recording of this, as we have done in the past, i.e. last year. So no need, if you do get stuck, you'll be able to watch this again if you so need to. At least you'll be able to fast forward to the exact section you want to address. So without further ado, Ifrs for SMEs, where are we now? I've already mentioned we essentially one review through. So the proposal is to have a review occur every 3 years. That's just to try and keep stability in what's supposed to be a simpler framework. Now, Ifrs for SMEs is undergoing a second one. And in this regard, there's a lot more on the table. Why? Well, a lot of standards in IFRS, full IFRS, have been changed, amended, or indeed just completely rewritten. If we think about some of the obvious ones, we've got revenue, we've got leases, we've got consolidations, we've got a couple of changes that have come through in business combinations, which would affect the section on BuzzComms and goodwill, for example. There's been a lot of change in terms of financial instruments, and let's not go there right now. So a lot of far-reaching fair value measurements, another one. So there's a lot of far-reaching or more, really difficult standards, I suppose, from an IFRS perspective, which haven't been updated in IFRS for SMEs. Now, in the build-up to our session today, I did a couple of chats with some colleagues, etc. And what are we hoping for? Now, any constituent that is perhaps an owner-managed company, nothing too complex, nothing diverse, no non-controlling interests, just a really simple, straight run-of-the-mill entity would say to you, well, it's not broken. There's no need to fix it. The issue really comes about with the fact that we've got a framework in the form of Ifrs SME that was built on Ifrs to start off with, and no one can dispute that. And what the intention was is to perhaps make it more simplified. So if we look at, for example, financial instruments, these were simplified quite a lot. They remain complex in their own right, but from an IFRS to IFRS for SMEs, we did see some simplification. However, now, as a result of these far-reaching or all-encompassing standards, for example, revenue and leases, we sit with very different principles in IFRS and IFRS for SMEs. We're never going to be able to please everyone, and obviously we've all got our own views, including myself. The ultimate for me is that if the standard was originally built on IFRS principles with simplification, surely that should remain the premise on which we then perform changes to that, in this case, Ifrs for SMEs standard. So I'll refrain from too many opinions at this point. Let me rather paint the picture, and then we can see if there's anyone that wants to comment in terms of the debate. The most recent meeting that the board had with regards to Ifrs for SMEs was in March. And in that regard, they tentatively decided to move it to a standard setting situation, which is where the exposure draft will be coming from. They also said that the scope of the review, of the second review, will be as has been stated in the request for information document. It is downloadable. It's quite a biggish document, 70 odd pages. And what's cool though is that it really runs through each of the topics on an individual basis and gives a lot of guidance as to what the questions are posed by the board. So feel free to go and download it, or if you do want a copy of it, I'm sure we can distribute that as well. I am generally not a big fan of distributing documents that are freely available on the internet. I'm not a distributor of the IFRS documentation. Those are generally easily accessible. From publishing an ED perspective, they are going to propose the amendments, obviously, regarding the requirements that were in the scope of the review. So again, focusing that it is isolated to the scope and the questions that were posed therein. And the proposed amendments that will be developed will be done using the approach that they mentioned, which is to treat the alignment with Ifrs as a starting point. And there has been some question. So just to put into perspective also that this was done in a part A to C format. A was to debate the alignment approach. B was to address the specific sections and changes that were going to be made in that regard. What was really nice in the request for information document is that they broke it down by section that would be addressed with its relevant questions. And where there was more information supporting why those questions were being posed, they provided that in Appendix B of the request for information document. C was an interesting one. It really was around other topics. Now, other topics not necessarily included anywhere in a specific section at the moment, also not particularly addressed from an IFRS perspective, one of them being cryptocurrency. So we'll look at that now. They did pose a couple of questions and they said, what do you think? Do we need, do we not need, should we, shouldn't we? And that's obviously also been taken care of in the feedback. The alignment approach deals with three basic principles. The relevance to SMEs. So is this change relevant and how relevant? And then simplicity and faithful presentation. Now, those two bottom ones, I mean, obviously once we determine whether it is or isn't relevant to SMEs, we then look very closely at careful not to oversimplify and thereby take away from or in any way, shape or form contradict our faithful presentation requirements. So the alignment principles are, in my opinion, sound. We'll be starting with Ifrs as the starting point, which, ladies and gents, I mean, you cannot argue with the fact that that has got to be the basic. If that's what the standard was built on originally, then it makes sense that we constantly do a check-in as to how far are we deviating from that original basis? And does it make sense, taking into account its relevance to the SME world and obviously the simplifications that have or haven't been applied in arriving at what is considered faithful presentation. Now, we can see here that we've got, support for or not. Just give me a sec. Just lost my sideboard here. We're always going to have supporters for and against. Now, when we look at the for, they seem to be more, there are more answers or more sections, more support, more reasons, there we go, more motivation as to why the alignment approach, the way it is, makes sense, or the way it's been proposed. Versus you can clearly see at the bottom here, where we've got those who don't support the alignment approach, believe that SMEs should be developed and amended considering only explicit and specific requirements of SMEs, and that we shouldn't be guided by full Ifrs. But there's no real, unless the board, and I'm not going to for a minute suggest that the board has left it out on purpose. So it just doesn't make sense to me that we simply say, well, we shouldn't use Ifrs because we shouldn't use Ifrs. I get that we obviously want to get to a specific standard that governs SMEs, but in the absence of Ifrs as a starting point, which was the birthplace of the standard in the first place, you can kind of see where I'm going with this. So let's take a look at just some of the supporting arguments. It's believed that it would be efficient. In other words, the board wouldn't have to reinvent the wheel. They've already, applied their insight in developing the full Ifrs standard in question. It's consistent with constituents' expectations. So here, if your voice hasn't been heard, well, sadly, the majority of constituents believe that having similar principles between Ifrs and SME standard makes sense. They also think that it's necessary for this alignment approach to be as it is because an entity seeking consistency with its larger peers would get that. There's an inverse to that, though, is that the argument that I've heard from a lot of people in the South African market is perhaps that, well, if I wanted to compete with my larger peers, I'd do Ifrs in the first place. So I don't want to, by virtue of not wanting to, I shouldn't have to deal with the standard that complex. Appreciate. So there's a bit of a for and against there. They also think that the alignment approach is conducive to an entity potentially migrating to full Ifrs. Here again, there's a counter argument. If we look at, for example, what's happened in the market of late, a fair few entities that I'm aware of have actually delisted. And now not only are they delisting, but they're also entering the fray of perhaps even changing to Ifrs for SME. That obviously takes a lot of thought. You really do need to consider the complexity of the entity, what's included, the whole katoot. But ultimately, we're seeing the inverse happening, perhaps in our jurisdiction, bearing in mind that Ifrs for SME is a global framework. So perhaps not something we're experiencing, definitely not in the current economic climate, but interesting nonetheless that an entity that wishes to migrate wouldn't have that far a leap to take if they did want to do so, considering if these standards were indeed aligned. And then they also consider it sufficiently flexible to allow specific requirements and characteristics that need to be considered. So again, supporters are saying, use it as a starting point, jump off and then go, okay, where can we simplify and what can we simplify? I think it's the what for me. It's not so much the how, because I think the how has perhaps already even been taken into account when the board applied its insights in actually doing the research, etc., relevant to the different standards when they were being changed. So that's that in terms of the alignment approach in part A. Let's take a squiz at which section. So part B dictated the following sections. You'll note bullet points 9 and 10 refer to multiple sections, and that's because fair value, as well as the amendments to certain Ifrs and Ifrics over the years, affect obviously a variety of different standards, depending on what the actual amendment is in terms of bullet 10. And bullet 9, fair value appears in a variety of different sections, as it does in IFRS, in full IFRS. One of the comments I can make at this stage around full IFRS fair value comment was simply that there were constituents in the request for feedback that gave information, that gave feedback in the sense that why not develop a fair value standard the same as what we have in Ifrs 13? I think that would make a lot of sense, but ultimately we'll have to wait and see, obviously, because there's no guidance as to where they were going to go on it. There were two schools of thought. Should we go and investigate each standard, or should we consider a single standard? And I think perhaps a single section would give us a lot of clarity around a single definition, for example, of fair value, like we have in full Ifrs, etc., etc. So just these two multiple sections, I'm not going to be delving into any depth at all. They obviously are quite far-reaching. Likewise, I'm also not going to be addressing each of these. A, because I could probably sit here and wax lyrical for quite some time on each of the sections and what the ISB is proposing, the board. Instead, what I have done is extract those that are of most relevance to perhaps what we can consider all entities. So I have looked at, as well as fair value, I've looked at the concepts and pervasive principles section, leases, revenue, and some fair value. So let's take a look at what the questions were and what they wanted us to answer. The views that they've requested on section 2 is, what are your views on aligning section 2 with the 2018 conceptual framework? Now, that framework became effective at the beginning of 2020. So we've essentially had it live for a year and a half now. Interestingly enough, myself and Alvin have actually had to deal with a question that forced us to go back to the framework. And what I want to highlight for you here is that we're dealing with a new definition of an asset and a liability. There's a lot of other guidance that's also been added, and a lot more meat in terms of the principles in building a foundation for IFRS. For example, we've got some guidance now on what is truly meant by substance over form, which perhaps not rocket science, but again, we've now got it in the framework, and it's now therefore going to be used by the board at all times, consistently when building a new standard. Likewise, we've got the principle of linking transactions. Under which circumstances is that appropriate? But I think for all of us, the definition of an asset and liability, the way we learned it and studied it perhaps in varsity, these definitions are quite different now. They require us to consider different pieces of the puzzle, and they make a lot of sense. But again, it depends on how well you've considered or studied them. So that there is, I suppose, what we are asking is, should we do these changes so that our asset definition, etc., is dealt with accordingly? In this regard, there's also a question around undue cost or effort. Should that be retained? Now, the board is of the opinion, obviously, that concept of undue cost or effort is made available to an entity applying Ifrs, obviously in certain circumstances only, and there is no equivalent thereof in the actual conceptual framework in full IFRS. So what they wanted to know is, should it be retained in section 2, in the sense that it provides obviously a mechanism for the board to use in balancing costs and benefits in the requirements of IFRS SME standard. I think it makes a lot of sense. I think that one is without too much debate. We'll see what comes out. I think that should be retained. I think perhaps the issue is in terms of judgment is when it is applicable, when it should or can or will be used. But I think in terms of the actual conceptual framework, it would make sense for, at the very least, for the definitions to become aligned. Will that change anything substantially? I'd go so far as to say no. In many instances, I mean, the fact that we've changed the definitions of assets in IFRS, for example, hasn't changed your PPE. And that's what the board is also saying, is that aligning section 2 with the conceptual framework would result in an alignment of other sections, for example, PPE, which categorically refers to the definition of an asset. Variety of the asset standards do just that. So we're going to update them, but we're not going to have a fundamental change. It's really just making sure that should we build on anything new, for example, cryptocurrency, if we need to go down the route of is it an asset, is it not, that we really consider the definition as it stands in full Ifrs and Ifrs for SMEs, and that these two things are the same. I think to have two different definitions, one dating back to, for goodness sake, I think, even earlier than the 80s perhaps, but we're looking at a fairly old definition, and we're sitting in 2021 where business and the types of things that we're dealing with, if just, for example, cryptocurrency, which has been around for quite some time now, it's just ever evolving. So I think all worthwhile from that section perspective. Section 9, not one that's perhaps also all encompassing for everyone, but
sorry, Kim, before we jump into 9,
yes,
we just had a question for the new definition for assets and liabilities. Is it still unchanged or only once the new framework comes in? I think just clarity on that with the framework's effective date.
Okay, so all right, so I did mention that the conceptual framework in full IFRS became effective on 1 January 2020. So we have obviously now got new asset and liability definitions as of that date. I'm not quite sure if that does answer the question. I'm assuming it was in terms of full IFRS that the question was asked.
Yes, thanks.
So we do have new ones. The new framework has already kicked in, and therefore there's no question about whether we should or shouldn't be using the new definitions. I haven't come across any transactions where, if you're looking at anything older, should I now use the new definition, etc. The question that I had was in January, and it was specific around a contract that had been entered into in May 2020. So it was very clear that the new definition was applicable. The board have also used the new asset and liability definition as of 1 January 2020 for any standards that are being either amended or developed. So that was the line in the sand there. Okay, to carry on, Al?
Yes, thank you.
I hope that does address the request. Section 9, consolidated and separate. The question here was just, what are your views on aligning the definition of control in Section 9 with IFRS 10? Now, Section 9's control was obviously built on, Section 9 control was built on the old IAS 27 standard, which was still in existence when IFRS for SMEs was built in 2009-ish. Subsequent to that, we've obviously had a replacement of IAS 27 with IFRS 10. To say it's a complex standard is, well, for us that deal with it perhaps more commonly, it's not so complex anymore. But if it's your first time, or if you haven't dealt with it at all, I do believe that it can read a bit nightmarishly. IFRS 10's concept of control comes from a situation where we say we're going to look at power. So we assess whether the entity in question, the investor, has power over the investee in question. We then also have a look at whether the investor has exposure to returns from that investee. And then we link these two, the power and the exposure, by saying, well, does the investor have the ability to use that power to affect the exposure that it has to the returns? And only when you have this all coming together do you indeed have control in IFRS 10. So very different to the situation whereby control was more looked at, do you have the power over the I suppose the strategic and financial and operating policies. That was really how it was as simple as that, which in its own right wasn't simple when we were looking at IAS 27. So the board saying, should we do this? I think without question, when it comes to a principle or a definition of a principle that's applied, we definitely need to consider it. But then in so doing, they're also asking the view on possibly retaining and or updating paragraph 9.5. Now, section 9, paragraph 5 states that control is presumed to exist when a parent entity owns either directly or indirectly through subs more than half the voting power of the entity. Now, this is a concern, I suppose, for myself. I have dealt with one or two queries. We've never really closed them off, though. I must say there's always a bit of a disparity between the client, myself, and the audit team in question. But there's an issue here for me by saying that more than half the voting power of the entity, because half the time entities think that shares are what we're talking about. It's important to note that voting power may very well emulate the shares. So if you've got 70% of the shares, you should have 70% of the voting rights, but that isn't always the case. And there's sometimes a bit of a misunderstanding of what is meant by this exemption. So should we retain it? I don't know. If anyone's got any clear views or comments in this regard, you're more than welcome. If you've experienced this guy in any way, shape, or form, also more than welcome. In this regard, the information that's provided in the request for information document, there's quite a lot of discussion about it. So I don't really want to go into too much detail. Not everyone is affected by consolies, but we can clearly see that by keeping that as a control presumption, if I can call it that, would definitely go against aligning control definition from IFRS 10. So, well, perhaps not fully against, but it could be considered a simplification, perhaps. I think the board would just need to give us a lot of clarity under what circumstances the simplification would remain in light of that control definition, if it is indeed updated in line with IFRS 10. So we could see a little bit of a difference coming through in consolies. They've also discussed a fair amount in terms of investment entities. I didn't put that on the slide because that is very isolated. In very few instances will we see investment entities applying Ifrs for SMEs. In addition, also Ifrs 10 has a requirement that investment entities measure an investment in a sub at fair value through profit or loss, and that they don't consolidate the entity. This is obviously not, there is no equivalent in Ifrs for SMEs. So the question is, should it or should it not be introduced altogether? Moving on, section 20 is on leases. And here, obviously, we're going to be talking a bit about Ifrs 16 in a second. But in addition to that, I wanted to highlight the questions that are being proposed by the IASB, by the board. So we've had this standard. Our dear friend IFRS 16 went live on 1 Jan 2019. So he's been in existence for just over 2.5 years now, assuming your reporting date is a December reporting date. For most of us, we've probably only really dealt with it once so far from a reporting date point of view, and that would have been our transition date. Some have probably just finished it now in terms of their February reporting date and or March. Now, we clearly see that section 20, I don't think there's any dispute that section 20 would have been built on the old IAS 17 as it was the standard in existence at the time. Now, the board, as I don't think the board noting it really is of major value, because I think it's common sense that many entities, whether on full Ifrs or on Ifrs for SMEs as a framework, have leases as a major source of funding. It's the easiest way, obviously, to obtain such. So the board is saying that in light of this, we need to consider, should we go with Ifrs 16, and what are the simplifications that we should make in such a situation. So I've highlighted a couple of these. On the actual slide before, at the bottom, it says they intend to simplify recognition and measurement requirements, addressing, for example, variable lease payments, the discount rate, and the term of the lease. They intend to retain the disclosure requirements of section 20. So how do we feel about that? In other words, our old finance leases. And then the intention is also to simplify the language. Simplifying the language, they don't really expand too much on. I'm not quite sure how much simpler we can make the language of Ifrs 16, but nonetheless, we'll wait and see what comes out of the ED. What I want to talk about, though, is the recognition and measurement simplification that they are addressing. So they're saying they're going to give us an option to use a discount rate that is with reference to market yields on high quality corporate bonds. Sorry for the scribble. I don't want to waste too much time by writing too much out there, but that's the idea, is that's the simplification that they're putting on the table. In other words, they're saying that if we can't determine the implicit rate, if it's not readily determinable, is what they're saying. The implicit rate in the lease, which, let's face it, is not something that the lessee has access to. I'm yet to come across one where a lessee has had access to the implicit rate of the lease. In most instances that I have been part of the query, etc., is on that we use the incremental borrowing rate. I'm not quite sure that it's really going to be an argument to say we can't determine our incremental borrowing rate. I haven't really lent too much thought to it, but under what circumstances would an entity not have an incremental borrowing rate? Perhaps if they haven't got any debt to start off with. That would be an interesting situation for me, but nonetheless, they are giving us an out in that regard. The other one is they're going to change the lease term, that as a definition, to instead be referred to as the non-cancelable period, which is, ladies and gents, which forms part of the definition of a lease term in IFRS 16 at the moment. But they're saying it will read as the non-cancelable period for which the entity is required to comply with the lease. And they go further to say that any extension would be a brand new lease. So what they're then saying, for example, is we don't have to apply ourselves as to whether we think it is reasonably certain or not that we will deal with an extension at some time in the future. So if a lease, for example, said to us, we've got a 2-year lease term with an option of extending for another year, we would ignore that extension option. We would only look at the non-cancelable period for which we are required to comply with the lease. Simplified, I think so. Does it deviate far from full IFRS? I think so. But the principle, I think, would still be somewhat the same. There's a lot of debate, and like I said, I don't really want to give too many of my own views, although I think we all have them. Let's face it, I suppose when you're supposed to be an expert in your field, you have a lot of opinions. But I think in putting an extension on as a new lease altogether, it does simplify things and makes it a little bit easier for us not to have to consider modifications or reassessments, so to speak. They do talk about reassessments. I'm not going to write, well, I suppose I can write that one down as the last one. They say that they intend to simplify remeasurement by requiring remeasurement in the event of only a substantive change. Change in the term of a contract. So if there's a term, there's a clause in the contract that is considered substantive and you change that, only then would you trigger a remeasurement. Again, that leads us to what is considered to be substantive. I think what we've got to be careful of is not wanting there to be any change versus how big can this change be. Well, to be honest, I think Alvin and I have had a lot of conversation over the last couple of weeks where we're saying, quite frankly, IFRS 16 is a lot bigger and a lot more complex than we ever thought, than I've ever considered. So if you think that moving to, from your transition, that you're done, think again. So obviously there's a lot to consider in building, or rather realigning, so to speak, Section 20 to what is the current leases standard. I'm grateful that they have obviously mentioned some easier simplification aspects, but by no means does that mean that we're going to get perfection. It's important, though, that we also understand that IFRS 16 does give us the true reflection of financing. You know, operating leases, in my mind, were always a bit off. Obviously, they were off balance sheet. My joke for the afternoon, apologies. So I think they were always a little bit off center because of the fact that there are obligations, and those obligations were not on balance sheet. And by not putting that on balance sheet, you're not showing the true reflection of the contract, the transaction in question. The last two, revenue and fair value. The revenue one, I've just given the three alternatives. I'm not going to go into depth. The views are on which alternatives should they apply and why. Should they modify Section 23 only to remove clear differences between Section 23 and Ifrs 15 without wholly reworking Section 23? Should they do a full rewrite to reflect the principles and language in Ifrs 15? And in terms of alternative 3, they're saying, should they just not do anything? I think there's a reference that the board has made. They said that they considered that although there's substantive differences between IS 18, the standard on which Section 23 was built, and Ifrs 15, the effect in practice for most entities in the scope of SME would be minimal in terms of timing and measurement. So really what that says to me is that the board is saying there shouldn't be too much of an issue for entities in Ifrs for SMEs, whether they use 18 or 15. My concern is more that we need to make sure that we have alignment in terms of principles and language, I think at the very least. So a full rewrite would obviously be my preference, to make sure that the concepts in Ifrs 15 are mirrored in Ifrs for SMEs, but obviously in doing so, again, address the simplification. So the main distinction is that we look at performance obligations either over or at a point in time, rather than goods and services. And most entities are saying, well, those things that are at a point in time are goods, and over a period of time are services. But I can assure you that we've seen both, cross those Rubicons. So there's no real clarity that there won't or will be a major impact. I think that there are some entities that are perhaps a little bit more complex in their revenue contracts. And as a result, if you look at, for example, construction contracts, etc., we would benefit greatly, I think, from using the Ifrs 15 language. But that's also coming from someone who is very familiar with these concepts. So I do appreciate that I might have a slightly biased view from that perspective. When it comes to fair value, they're asking, should we align the definition of fair value? I think you've clearly got my view as being aligning definitions for sure. Should we align guidance on fair value measurement in Ifrs, in SMEs with Ifrs 13, specifically from a fair value hierarchy? Principles of fair value hierarchy, should we put them in? Should we include examples? Well, I think that goes without saying that if we are going to include the fair value hierarchy in the standard, then make sure that we do indeed include some examples, especially those that would be most relevant to SMEs, those that they would most encounter. And then should we move guidance and related disclosure requirements to Section 2? So this is just saying, should all of the fair value measurement aspects be incorporated in Section 2, and we saw here Section 2 is around concepts and pervasive principles. I think, in my opinion, I would favor a separate standard with a separate set of whatever those disclosure requirements might be. By no means am I suggesting that we go down the road of the disclosure requirements as they are currently in IFRS. I think that would be fairly unnecessary from a volume perspective. But I think the principles of the fair value hierarchy, levels 1 through 3, and what they purport, to present from a faithful presentation point of view, I think is necessary. We'll talk more about that. Alan also alluded earlier. It is one of the main issues that the JSE addressed in their review is IFRS 13 and its disclosures. People say to me, well, and I don't want to get too caught in IFRS 13 and fair value measurement issues, but I've had a lot of entities where, and audit partners for that matter, say to me, well, why can't we just do historical cost? I'm not sure that that's a true reflection of where we are in terms of 2021. I think fair value has a place. I appreciate that it is subjective, but I think if we applied the principles that have been given to us in a very well-written standard, and we actually tried to move with its subjectivity in order to get to a point where it's more objective than subjective. And I hear how daft that sounds even when I'm trying to say it, but I think ultimately we're so stuck in, we don't want to have any judgment being applied by whether it be the client and then obviously the auditor. Judgment opens us up to scrutiny. But I think that there's value in a set of financial statements reflecting the appropriate amount. Fair enough, if we weren't fair value accounting, perhaps there would be less space for fraud and for making things up as we go. But I think to enter a world of historical costs is definitely not one that reflects value. Is there a hybrid? I think we all have our views on that as well. I think what's easy is to perhaps apply historical costs because then there's no thinking involved. There's no objectivity versus subjectivity, and there would be no place for judgment. So this is always going to be the catch-22 with having principle-based standards. And I think from that point of view, I'm just going to leave it as it is because I will wax lyrical if I'm not careful. The topic's not addressed in SMEs. The question here was just, should these be aligned with full Ifrs? There's not necessarily saying that all of these are addressed in Ifrs. They will or can be and are currently being. Regulatory deferral accounts, this is really just from a regulator perspective, for example, an Eskom and Mercer situation. So currently we've got a standard on it called Ifrs 14, and even in its own right, that is just a temporary standard. It's intended to be finalized and put into a full form at some point. Don't think it's applicable to anyone. We don't have regulators in this country, I don't think. I'm not quite sure of all the different types of regulators, but the one that I'm most au fait with is from a Mercer Eskom point of view. Cryptocurrency, should we or shouldn't we address it? Should there be simplifications in terms of a defined benefit obligation? That's obviously a very isolated incident. I've only seen one, funnily enough, over the last, I'd probably say about 9 or so years. It's not something that's common in entities anymore. And then they just have this generic other new topics and any additional matters you'd like to raise. So they have left it pretty open-ended for constituents to comment as they wish. In this regard, and before we're on the downward slope to a tea break, I am going to just take you through the feedback summary. Now, as I mentioned, this document has been circulated with the slides, so hopefully you all have that now. Obviously, I didn't circulate the Ifrs for SMEs, the entire second comprehensive review request for information doc. Here, I'm not going to talk through any of these slides. I actually just wanted to highlight to you the tables from pages 34 through to about 40 odd and what they've done. So in table A1, they said the board is seeking views on aligning SMEs with what's been done in IFRS. If we just take a squiz, we can see that the effective dates of each of these different amendments in full IFRS have been noted, and then they've given a very brief overview of what the amendment does. The board's rationale as to why this amendment in IFRS should then be included in the relevant SME section is then also provided. That obviously deals with table 1. Most of these I don't see being a massive issue. The first one is always a good one when we talk about materiality. The definition of material has been changed in full IFRS, in IS 1 and both IS 8, which deals with accounting policies. And this is where they want to bring it in, is obviously in section 3. And the clarification would assist a preparer in applying the SME standard in relation to materiality. So it goes on then in terms of the different amendments that have been made already and have been effective. Same on the second page with sections 18 and 26, intangible assets, as well as share-based payments. And these are all amendments you can see that date quite far back. In actual fact, they date as far back as to when the Ifrs SME standard was first going live and applied. The amendments continue from a Table A1 perspective. We then get to Table A2, and this is where they're saying the board is requesting views on leaving Ifrs for SMEs unchanged in this regard. They again give their rationale as to why they would suggest leaving it unchanged in respect of these different amendments. This amendment, for example, requires IS1 will clarify IS1's requirement regarding materiality, the order of notes, subtotals, policies, and disaggregation. On the rationale side, they say that the Ifrs for SME standard includes simplified drafting and simplified language, and therefore doesn't require an entity to provide as much detail as we see in full IFRS. The board recently published proposals that could result in a new IFRS standard. Now, this one makes probably a hell of a lot of sense for all of us. If we're going to get a new IFRS, which is ultimately going to have to be considered in terms of being applied then from an SME's perspective, why double up on the work if we're currently working on a bigger project? So for those of you that aren't aware, if you follow Ifrs for SMEs closer than what you do at full Ifrs, we are looking at a project that is going to pretty much change the look and feel of our presentation and disclosure for all entities, specifically looking at, I want to say, the statement of profit or loss and other comprehensive income, but most of us are most au fait with it being the income statement. So that statement is going to look quite different in the future. And they've dealt with a lot of discussions. They've had a lot of webinars in this regard. And we're hopeful that we'll actually get this proposed standard at a finalized stage. So no real point in doing that right now. And I think that rationale stands. I'm not going to talk to the rest. As you can see, these are just ones where they're saying, let's leave a sleeping dog lie. And they've given their reasons for it. I think the moment we see a table that's in our favor of leaving something alone, we're probably more comfortable in doing so. Getting then to Table A3, this is where the board is requesting further information on whether to align or not align. These here are isolated, perhaps not considered very common issues amongst entities, whether on Ifrs or on SMEs. In my opinion, there's some here. The first one, perhaps, I don't see too many investment property entities in the realm of Ifrs for SMEs, but this clarification came through that says a specific transaction meets the definition of both a business combination, as defined in Ifrs 3, and investment property. So, and what do we do when that happens? So it clarifies that determining whether it does or doesn't, in terms of Ifrs 3 and then obviously IS 40, requires separate application of those standards independently of each other. That there, should we bring it into Ifrs for SMEs or not? I think, in my opinion, I'd say not. I think that there's so few instances where an SME entity would be faced with that, but I stand to obviously be corrected. We're about to break for tea, so just give me a sec while I finish the last two tables. The board will consider it along with the Ifrs standards they amend. For example, here we've got consoles, and we're saying that the amendments provide an exception to the console requirement in Ifrs 10, requiring investment entity to do the fair value through profit or loss. That there you can clearly see they are considering whether that should or shouldn't be amended. So here we've got table 4 addressing all of our what should or should not be amended and how. Table 5 then says amendments to Ifrs standards with which SMEs is already aligned. What's nice here is that they've said not only what the clarification is, but they've then told us in which paragraph of which section that is met and has been addressed and how. So I just wanted to highlight to you that pages obviously 35 or 34, sorry, through 46 of the document that I've given you, what it also does is it nicely summarizes all of the feedback that has been given. From that perspective, I thought, let me just take you through. So this is what the document looks like. You should have a copy of it. It tells you what the purpose is. It tells you the background of where it comes from, how many people or how many entities, rather, should I say, are able to apply it based on jurisdiction. This is a nice breakdown by region of which regions do allow it, don't allow it, and allow it as a point of reference. The sources of the feedback, who they went to, how many letters they received, and who the letters were from. And then obviously getting into the actual feedback. So here they address it, the alignment approach, the principles, when, the conceptual framework aspect around section 2, the Ifrs 10 definition of control, and you can clearly see it goes through all the different pieces that we have just discussed. It gives us a good indication of what the answers were, what they were based on, why they were given as such. There are, not everything is going to be supported with a full motivation, but nonetheless, it gives us a good indication of where our exposure draft might be going. With that said, I think let's indeed break. I've got 15:02 on my screen at the moment. We've just gone 15:03. If we can all be back by, let's try for 15:11. So let's go for an 8-minute break. Hopefully that's enough for everyone's kettles to boil. I will see you in a short while. Thanks, everyone. I also needed to highlight, I know Alvin mentioned to me in the break, there have also been a couple of questions on when is it going live? What are we dealing with? So please do note that what we just discussed now is literally not yet the exposure draft. What we were discussing now was only the request for information, questions / comments from the board. So in other words, the items that we discussed and that are included in the request for information document are what the board put on the table as to should we or should we not. And based on the feedback that they obtained, which is what we also just addressed, so the feedback that they received, they tabled all of that in December 2020. And the next step is indeed an ED. And as I mentioned at the very beginning, perhaps if you dialed in just after my intro, the ED, we don't know when. There is no information posted on the work plan on the ISB's website. Normally, when they move from a research project to a standard setting project, they will also give an expectation of the exposure draft date. They haven't done that. I expect that that might simply be just because of the volume of projects on their plate. But the when, I'm quite certain we can bank on an ED by the end of the year at least. And I would then, if I were you, possibly just put it on my radar. Do I want to have, do you want to maybe have a discussion on that once the ED is out? We can always have a look at that with Earl and the team and give you some indication as to where that exposure draft is going based on the feedback obtained from the request for information. So again, once the ED is out, there will be a comment period. And as constituents that are in the SME standard, I would implore of you to make sure that your comments are indeed heard. So that's the status of this project is really, for all intents and purposes, is nowhere, okay? It's in the ED writing stage. All of the comments that we've just mentioned now were part of what should they be focusing on. So the board went and did research, said these are the things that are of note. These are the things that are different between Ifrs and Ifrs for SMEs. Do you want us to address them and how? Without further ado, let's rock and roll into some Ifrs 16. Ifrs 16, you'd be mistaken in thinking that you are A-OK subsequent to transition. Transition, if I can just speak from mine and Alvin's perspective, was an absolute nightmare. I think every entity that I've ever seen has a lease, And most of them actually have operating leases rather than finance leases. And in transitioning to the standard, well, yeah, it couldn't have been more complex if we tried, not only from the actual working point of view, but the toughie actually came through also in the disclosure. And many entities that I've had chats with were like, oh, thank goodness that's over. Well, brace yourself. Whether it be because of COVID, and like I said earlier on in the discussion, I don't think everything can be blamed on our dear friend COVID, but we have seen a lot of changes occur in leases subsequent to transitioning to the new standard. So some of the practical things that Alvin and I have experienced in a variety of different clients that we deal with is, and what we hopefully will give you some insight into, by no means do we intend for any of our examples to be a cut and paste for you or your clients if you're an audit firm. But we've experienced some of these. We want to highlight some of the nuances, some of the difficulties, and open up the door if you need help. Well, yeah, we're here. Just all you need to do is simply ask for it. Sometimes it can be as simple as finding a publication that addresses the issue, and what was perhaps considered complex could be an easy out. But I hate to say that would be rather the exception than the norm when it comes to this standard. So, well, let's take a look at components. I've got some separate slides here, and we'll talk about components from whether it's a lease component versus a non-lease component. Can we combine? Well, the standard says yes, there is a practical expedient to do so. But what are the implications thereof, and does it make sense? Lease term, the $1 million question. Probably the more complex, I think, that I've had to deal with definitely is lease term. And it is talking about two aspects. One being the non-cancelable period, whilst we then also have to deal with what we call the enforceable period. And I know many people will argue that shouldn't be me. So these two periods and how they play a role in determining the lease term can be quite complex. For the most part, they may not be. But if we don't know about these two concepts and how they play a role in determining the lease term, you could end up with the wrong lease term. And the lease term, we'll see shortly, has a direct impact, obviously, on the amount of your lease liability. Commencement date, well, I can address that right now. So it's one where we don't have to do a separate slide. The commencement date was a question around when we have what we call a beneficial occupation period. The standard does specifically address this. It's in Ifrs 16, paragraph B36. It says any rent-free periods form part of the lease term. So what that then does is, if we consider, if we were to have, let's do it like this, if we have a 60-month lease term, and I'm just going on, that has been determined to be the lease term. And our question is simply around, should we or should we not take this, what was defined in our contract that we looked at as a beneficial occupation period. It's also, as I said, sometimes referred to as a rent-free period. So this 3 months, is it in or is it out? We found the client was quite vociferous about the fact that this didn't form part of their lease term. The lease term is very defined. And what we were trying to get them to understand was obviously that we've got a contract versus what IFRS says. And IFRS very clearly addresses any periods within which you are allowed to occupy the premises in any way, shape, or form. In other words, you have received the keys. The fact that you don't have to pay for it, and it has been addressed as a beneficial occupation period, i.e. a rent-free period, your lease term would then be 63 months. In that case, obviously, your commencement date, in this case, for whatever case, it doesn't matter about the actual date that it was. Let's say that the lease term only started on 1 July, and the rent-free period commenced obviously then on 1 April. 1 April would be your commencement date. I've had another similar query about end of last year. And, the reason why this is important, apologies, is that it's on the commencement date that you are required to recognize your right of use asset and your lease liability. But obviously for those 3 months that are beneficial, i.e. rent-free, your lease payment would be 0 on your timeline. Another question, as I was saying, that I was faced with at the end of last year was a client had a reporting date of December. A lease was signed for commencement on the 1st of January. But for whatever practical reasons, they decided to move their stuff into the premises. And the permission was given to do so on somewhere in December. Now, the issue with that is perhaps, is 2 weeks really an issue? I get that the reporting date is the concern, but the fact of the matter is that you are taking occupation. So there were other facts and circumstances, and I'm not going to go into that, but the question should at least, present itself to yourself as either the client, the preparer, or the auditor. Is that lease to be recognized in the period ending December, or does it indeed only commence on the 1st of January? And my gut would say that we're moving towards a December liability. But as I've already mentioned, every single requirement, every single transaction has its own facts and circumstances and need to be carefully considered.
Sorry, Kim, we had a question on the commencement date. So you have your 2 months rent-free, but your electricity and water wasn't working, so you couldn't move in. So the argument there that was put forward is that the asset is not really ready for use yet. Your view on that?
Well, I hate to say that IFRS 16 does not talk about an asset being ready for use. It's the concept there is of gaining control of the asset. Now, access to the utilities that come with that asset. I'm very hesitant to obviously give a view on this one, as it's not one that's been presented to me before, and I would need to give due thought. But the basic for me is that we've got to be very careful of using ready for use, which is an IAS 16 concept of recognition, versus getting control of the underlying asset in a right of use lease liability situation. So if you've got the building and you've got the right to occupy it, I would be very hesitant to say that the lease has not commenced. Remember, the lease is not of the utilities. I appreciate that the utilities make the place habitable, if we can call it that as a word. There would definitely be merit in considering how much of a role the utilities play. But yeah, my gut would say that you have the opportunity to occupy, and yeah, unless there's a different issue, in other words, the landlord has postponed it because he's not comfortable because of the utilities, that becomes a very different issue. But if the landlord is saying, well, yeah, you've got access, you've got the keys, sorry about the lights and water, we'll sort that out with whatever city of, let's just say COJ, City of Joburg, I don't see how that impairs the commencement date of your lease. I see there's a comment in terms of yes, they will. Al, is that part of the original question?
No, that was just the previous comment. Thanks, Kim.
Okay. So yeah, I think whoever posted that one, it is perhaps worth a discussion, because I think there are more facts and circumstances around that as to what is the landlord's role in this, what does the actual contract stipulate, and this is a perfect example of a contract that may or may not take care of all the different nuances. So I do want to stress that is something we're seeing, is that contracts, perhaps not, I can't say specifically for the South African jurisdiction because I haven't had to review too many from a global perspective, but it's very interesting how simple some of these contracts purport to be. And in the case of an issue of what could be considered breach or just non-service, how do those get dealt with? So at least to make sure that your contract does deal with breach and or remedy, some remediation is important. I just the only thing I want to highlight from that question, Alvin, is specifically commencement date and right of use assets in IFRS 16 have nothing to do with being ready for use. It is the date on which you gain control of that asset. So generally, if you've got the keys, rock and roll. The next two blocks, if I can move on there, these, well, I suppose more than just these two, there are a few of them that pertain to any kind of reassessment or modification. So Alvin and I have split these two concepts, if I can call them that. So the standard says, in the case of modifying a lease, what do we do? And then we've also got what the standard says in terms of remeasurement of our lease liability, and obviously how it flows onto the asset. The remeasurement of a lease liability, what we've talked about here as reassessment, is specifically addressing reassessment in light of the existing terms and conditions. Whereas modification talks about a change, generally a renegotiation. So we try to draw some distinctions for these so that it makes it a little bit easier, but by no means is there a clear, if we do this, it's that, if we do that, it's this. There are a couple of yes-no diagrams that need to be considered in arriving at the correct answer and the correct accounting. The modifications do, depending on what type of modification, whether you have a separate new lease or not, they do take you down the same guidance as if there is an existing change. So we'll have a look at that now. It can be a little bit confusing, and trust me, I still need to start at the very beginning every time there is a change and or a change from an existing lease contract. So if there's a clause that says, if this happens, then we'll do that, versus it's not addressed in the contract at all and therefore results in a renegotiation. How does that play a role? I've included a slide, but I'm not going to talk in any depth about the COVID-19 rent concession. We got an amendment, was given to us last year in May. So the ISB had a very quick reaction to the COVID pandemic, and they have subsequently prolonged it. So they re-looked at it in light of the fact that we were perhaps overzealous in thinking COVID would be done by June 2021. And they've extended the practical expedient to June 2022. Early cancellation. Let's take a look at an early cancellation situation. We recently experienced where an entity decided to cancel early. I'm not going to go down the road of just too much in terms of the accounting. Should it be combined? Should it not be combined? Let me see if I can try and speak English in terms of this regard. So if we're going to early cancel a lease, we're obviously sitting with a right of use asset that may or may well be a year, in this case, possibly 2 years down the line. And we've got a lease liability. Now, the right of use assets, the principles applied to it are very much those of IAS 16 in terms of its subsequent measurement. In other words, we depreciate, and likewise, we are required to consider for impairment. The lease liability, we should all be comfortable with. It's got its finance costs, and it will unwind. So when we early cancel this, considering that it is all one transaction, there could be a slight mistake here in saying, well, let's collapse these two things and we'll end up with a net gain or loss, so to speak, in your profit or loss. Please note that the lease liability, if it is extinguished, in other words, it is called to an end, we are required to look at that in terms of IFRS 9, in terms of financial liabilities, and what do we do when we extinguish those? So you look at the lease liability separately, i.e. you're going to end up with, no doubt, a gain on, I'm not going to write out the whole extinguishment of a lease liability. And in so doing, if you no longer have a right of use asset as the underlying of this lease, well, then clearly impairment kicks in. We can't rush the depreciation. You no longer have the asset. So it is you impairing your right of use asset down to zero. And that impairment, ladies and gents, versus the gain on the extinguishment of the lease liability will be presented separately. The ultimate, if we were to present it as a net gain or loss, which please understand is not permitted by, IFRS 16 doesn't talk about derecognition at all. So we do need to look at these two items individually in terms of their subsequent measurement. But the ultimate answer would reflect the same in P&L. It's just a question of getting the classification of the items correct. So that's something that was perhaps on Alvin and I a little bit sooner than we expected. In terms of evergreen leases, this does also tie back to our lease term situation. And I'll give you some guidance on that in a sec. And then a tenant installation allowance. This is not something that we see commonly. Alvin and I have dealt with it a couple of times whereby, for example, an entity, the lessee, gets an allowance from the landlord to make changes as they need or see fit to do. Generally in the beginning period, in another instance, we've seen it where they've had it available to them for a 5-year period. So depending on the size of the building, if I can, for example, say we get R1 million to do with as we please, as long as it is towards the benefit of the building. That there, you might think, well, very simple, I'm getting some money. We are going to go back to the beginning in a sec. I just want to go straight to the tenant allowance and get it done. The issue here is around the fact that this obviously walks and talks like reimbursements of costs in relation to leasehold improvements. And the question is, should this reimbursement from the landlord, the lessor, be considered a lease incentive? Because lease incentives are addressed as obviously a reduction in the lease payments and therefore factor directly into your lease liability's present value. There are a few publications and there is some guidance that tells us that it all hinges on who controls the leasehold improvements. And if they are considered to be the lessee's assets, then it is a lease incentive. The issue that comes with that is, like I just mentioned, let's say we get the $1 million and it is to be utilized in the first 6 months or not at all. The question is, where do we plot the timing of those cash flows, the reimbursements, i.e. the lease incentives? And because that has obviously a direct implication on our measurement. There is a document, it is part of the documents that you will receive, as I mentioned earlier, a Grant Thornton publication. I will just make sure that it does include what I want to address here. This one is specifically on tenant installation, and it might not be in the lease term one. Nonetheless, I'll make sure you get it. But Grant Thornton have a view that says we should estimate when we think that will come in. In the specific query that Alvin and I dealt with, I obviously had a view, in my opinion, I wasn't too confident that estimating the cash flows was appropriate. But in another question, for example, we saw where an entity had, let's say, the same $1 million, and they could utilize it over the 5-year period of the lease. That becomes quite difficult. So I just want to highlight that your estimation of where that lease incentive cash flow should be plotted would only be relevant if it is a lease incentive. And again, it would only be considered a lease incentive if we concluded the lessee controls the asset. If the lessee, however, is considered to be constructing the leasehold improvements for the lessor, and those improvements are considered to be controlled by the lessor, then the lessor's payment to the lessee is for those goods and services. So basically, they're buying the assets from the lessee. They're paying the lessee to do this work for them. And that's why it's then seen as a separate good or service provided by the lessee. On the over page, I have a list of, and I've included non-exhaustive indicators. These are indicators, you're not going to find these in IFRS. These are considered by the various different publications, mostly at a Big Four level. Indicators where we can see the lessee being the accounting owner, i.e. control of the leasehold improvements. These would give you a very good indication of who does control or doesn't, specifically looking from the lessee's point of view, obviously. But I want to highlight that there's going to be a severe amount of judgment in this regard. And in the queries that I've dealt with, there is a lot of judgment, and there is a lot of space for getting a different answer. However, the judgment that where we've arrived at an answer, we've really looked at the weighting of the indicators in the specific scenario, using these indicators that have been provided by the different publications from the Big Four, and assessing which of these may have more weight than not. If I look at these, for example, there's one that bears a lot of relevance, and it's almost smack bang in the middle. The lessee is not required to provide evidence of costs incurred in order to receive reimbursement. In most cases, we've seen where the lessee has to provide proof of costs. So that for me is quite a weighty one. And if we're saying no to that, then for me, it's clear that we don't have the lessee owning the asset, in which case it is then not considered to be a lease incentive. And that makes it then a bit easier for us not having to estimate the timing of the cash flows. I'm not going to read them all out to you. There are 6 of them. Does the contract require the construction? Are we allowed to remove any of the improvements at the end? So in other words, will they stay with us? Do we have to bear the risk of overruns? And there are 2 more. It really all depends on what is taken care of in the contract. And again, I can only just emphasize the amount of judgment that goes into this. I think that perhaps a tenant installation allowance might be considered attractive going forward. I don't know if there are entities that are currently looking at this or being exposed to this with their landlords. It might be something to consider discussing if you do intend on staying somewhere. It might be more in terms of a specialist or a really big entity. But let's face it also, I suppose leases of property has diminished with everyone working from home. Going back to the rent concessions, I said I wasn't going to talk in detail. The 3 concepts or the 3 requirements have stayed the same. They are all required to be met. I just wanted to mention that the extension is effective from 1 April 2021. The original amendment was effective from 1 June 2020, but could be permitted for financials that had not yet been authorized as of 28 May. So just to remind you about the timing, obviously I have only included the amendment, so the extension as I can refer it up to next year. So clearly this refers to next year's 2022. And one thing I wanted to highlight is in terms of the C criteria, where it says there is no other substantive change to terms and conditions of the lease. Picture this for a second. Lessee is granted 3 months, whether it be relief in terms of forgiveness or deferral. And the way that they've incorporated this into an amendment of the lease is they bumped up. So if they've forgiven or perhaps possibly even reduced the lease payments for 3 months, what they then did is they said, let's bump up the other payments for the remaining of the lease with time value of money to make up for the lack of, if I can call it that, lease payment in those 3 months. Ladies and gents, there are a couple of guidance pieces again in terms of publication, as well as a podcast that I found that PwC discussed this in detail, and that there is not considered to be a substantive change in the T's and C's. So in other words, yes, there's a reduction and there's a bumping up later on, but that bumping up evens everything out. So in terms of we're not getting a change in the consideration because everything is evened out if you compare PV now on the old to PV new after taking into account relief. And obviously the payments are in terms of what's due before 2022. And the fact that we're then doing the bumping up to equalize that consideration is also then not considered. Possibly even adding on an additional 6 months to a lease may not be considered a substantive change. But this requires very careful consideration. So if you have had a rent concession, or perhaps might still get one in the next year, we see it in certain jurisdictions it's been made law in ours not so much, please do get in touch with us, because there's a fine line between what I believe could be considered to be a substantive change in an existing T&C versus not. So going back to our components, before we get into the components, I just want to speak to a KPMG Leases handbook, very useful document. And what they've actually done is, instead of publishing this thing as a single handbook of a gazillion pages, this, you can easily Google this. If you simply Google KPMG Leases handbook, I assure you, you're going to be led to this page. This here is just an image, a copy of the image, and you can clearly see where they address the different aspects. So transition is dealt with in a separate chapter. The accounting model, there's an overview, there's the definition, discount rates, payments, and the lease term, the very dreaded lease term. We've then got modifications, nasty, lease components, what should we do, combine or not, and then the rent concessions, specifically, obviously, this amendment that has been issued. And then sector-specific guidance that they've also given us is from a tenant and a landlord, both addressing the real estate sector. So very helpful if you do want to go and do the research, etc. yourself. Often, I know Alvin and I, we're dealing with the client, they'll ask us the question, we know where to go, we know what to look for, and the answer is, well, at least we've got the guidance to then apply to the relevant facts. This is just a reminder, in recognizing a lease, it's driven by the lease liability, and it takes on a couple of different forms, and our lease payments, as well as the discount rate and the lease term, hence why these items are so important in determining the actual amount. Should we or should we not combine? The practical experience allows us to combine both lease and non-lease components. This will result in an increased, a higher lease liability, but it is fairly easy. So there's a payoff. It's easy to do so. This might be the case, you know, if we choose to do so. If we choose to do so from simplification in SMEs, who knows what that outcome will hold. If we don't apply the practical experience and we only address lease components, this, if I may use, is a truer lease liability. It reflects the true lease payments, obviously, and we are then required to clearly distinguish between lease and non-lease. If you are utilizing the practical experience, that, ladies and gents, is taken care of in your accounting policy. Vice versa, obviously, if you're not. Some components that we've seen, you've got your rental, your operating costs, and property taxes, insurance. Perhaps there's some additional space I've seen, such as patios, which is defined specifically. And then parking, which in some cases is fixed. You get 40 per month, that's it, done. Alternatively, they monitor how many parking spaces you use. That we need to make obviously sure that each entity assesses and decides what is best for them. You can appreciate that that could have a very big impact on your lease liability if you don't. In light of some guidance, I wanted to mention that specifically on property taxes and in some cases insurance, where it is calculated as a fixed percentage of the tax value of the property, this lease payment is then variable, obvious, okay? It's very clear. It's not based on an index or a rate, but it is variable. The standard says that these lease payments are expensed as incurred, or alternatively, if they're only going to be paid later on, you can include them when they are triggered, you know, and that's, for the most part, we see them as expenses incurred. That's the easy one. The guidance from PwC, which has proven very helpful, is that the amounts are considered known, obviously, for at least the next year. It generally is that your property tax will go up by X%, and you'll know that for the following year. However, we don't necessarily know what it's going to go up with in year 2 or year 3. So what PwC's guidance says is that it is in substance fixed, and it's therefore included in the initial measurement, but only obviously for the first year, because that's the only thing we can bank. Then, at the end of year 1, your variability relating to year 2 becomes known, and we include that for the next year. People should then be asking me, well, Kim, does this not result in some kind of a lease modification or possibly some kind of reassessment, what it results in is remeasurement at the end of each year. But it specifically is scoped out of being a lease modification. It's addressed in 1636C. And what this also says is we continue to use an unchanged discount rate. So where in substance fixed becomes, it results from variability. So your variability in the beginning, it's very variable for years 2, 3, and 4. We have no idea. We're not allowed to estimate. So once that becomes known, becomes fixed, we then include it. And like I said, that will not result in anything more than changing your lease liability and your asset for the year coming up. Useful guidance? I think so. There's been some deviation in practice, not ideal. I've mentioned the issue around, and there's nothing for me to discuss here other than to say non-cancelable period and the enforceable period both play a role in determining our lease term. This is very complex. All I wanted was for you to be aware that it can be slightly nightmarish. Another document, as I mentioned, the GT document will come out, and that'll help us with looking at some facts and circumstances relating to the lease term. Some from a contractual or a market perspective versus the asset perhaps being the specialized or where it is located. You know, it depends on whether we will or won't exercise certain rights within, or extension options, should I say, or termination options. And those need to be taken into account up front in IFRS 16. So those play a big role in getting our lease term correct. Evergreen leases, we've also experienced a lot of queries in this regard. Not easy. By no means do I purport to have it all down pat. What we do look at with Evergreen and even with intercompany leases is as much of the other supporting documentation as we can get our paws on. From an Evergreen lease, where we have a day-to-day, week-to-week, or even month-to-month, yes, it could be a short-term lease, but it isn't automatically the case. Because if we have a very short non-cancelable period, then the likelihood of us exercising a renewal, and most of the time these are also silent on renewals, so it really does complicate the situation. Evergreen leases might seem like they are very simple and that we can simply account for them as 12-month leases and taboo, but I think entities are very short-sighted in thinking that that is indeed what the standard has, the spirit of the standard has in mind for us. So if you've got any of these, please do reach out. It's not to say you've got the wrong answer, but we might not be there. This slide just draws the distinction between modification and reassessment. Modification is a renegotiation that was not part of the original T's and C's. A reassessment is a change that is triggered by a clause already part of the lease contract. So we can see a clear distinction, but it isn't always that clear in the actual contract and how we need to go about it. These are the yes-no diagrams, and I'm going to stop myself from getting too into this because the whole idea behind our IFRS 16 session was to draw attention to the fact that there's a difference between a lease modification and a reassessment. The lease modification accounting could result in very similar to remeasurement accounting, obviously, but that all depends on where you end up from a modification perspective. So you could have a separate lease, you could have an adjustment only because it's not a separate lease, or alternatively, if there's a decrease in scope, also an adjustment because it's not a separate lease. That all depends on your facts and circumstances in the relevant situation. When we look at reassessments, or more appropriately, remeasurements, the standard dictates to us under what circumstances we use an unchanged discount rate versus a revised one. These are very clearly addressed, and therefore we need to be very careful when we get here that we follow the right yes/no. The result of changing your lease liability in most instances will result in a change in your right of use asset. But what it has done is it's also said to us, carefully consider the right of use asset if it's a reassessment of lease term, purchase option, guaranteed residual, or if you are reassessing variable lease payments that depend on an index or a rate relating to future periods, we have adjustments to ROU. Alternatively, we have recognition in profit or loss. The obvious one there is on the right here, where a variable lease payment that does not depend on an index or a rate will always be taken into P&L. That, ladies and gents, is your scare tactic as far as Ifrs 16 is concerned. I think that there's a lot there that we could talk about. Like I say, Ifrs 16, just the permutations are endless, and everyone's lease is different. I note that I have very few minutes left. I might ask you just to stay on for an additional 5 minutes, if that's even possible. For those of you that are still on, I note that we have obviously reduced in some size, not too much. But I'm not going to go through any detail on the JSE other than to highlight the Ifrs 13 and some of the other issues from a disclosure point of view. I have included rather on the slides, the JSE's documents and where they can be found in terms of their website. These are just the most recent set of docs that were issued from an accounting perspective, looking at the report back, some combined findings report. It's great. That document's pretty cool because it takes into account all of the findings dating back to, I think even as far as 2014. Then one specific one that comes to light, and we dealt with last year in 2 separate sessions, was the Ifrs 9 and 15 thematic report. Then one that is specific to a sector is the investment property findings report. And then there's the activities of the FRIP and so forth. So the JSE is very much on the money. I see there's a comment here from France saying, what is the impact on the lessor? I'm not quite sure in terms of what question specifically. If we're looking at Ifrs 16, lessor accounting didn't change. So there's some additional disclosure requirement changes, but the accounting for the lessor has not changed at all. So from that perspective, we're still good to go. Lessors still have finance and operating leases in Ifrs 16. There were also some COVID-19 documents that came out of the JSE, all issued last year, and all needed to be taken into account. These are useful, ladies and gents, even if you are on Ifrs for SMEs. I get that there's a lot of information thrown at us, and from a regulatory perspective, we need to comply with a lot. But for me, it is important that if you are a preparer, if your name is going on a set of financial statements, I would definitely utilize all and sundry at my disposal, specifically looking at stuff that comes out of the watchdog, a watchdog such as the JSE, to consider carefully whether I perhaps could incorporate any of these, not only from an improvement perspective, but perhaps just from a basic of compliance. There were 25 findings on fair value matters. Most of them, well, I say a third, I say most, they say a third. A third of them related to investment property disclosures. So not necessarily only investment property entities, but those that also had investment property disclosure applicable to them because maybe they just had a property of such. So we got a report on the 3rd of November 2020 encompassing all of this. And what they really try to emphasize is that when we look at this fair value hierarchy, which remember we said might be introduced to SMEs, the issue lies at level 3. So there are detailed quantitative and qualitative requirements. And the reason for that is because it does represent the most subjectivity because it's unobservable inputs used in deriving the fair value for a level 3 item. Level 1 and level 2 would, common sense prevails, require less disclosure because there's less ambiguity, there's less chance that you and I can disagree. The requirements of all levels are to provide evaluation technique, whatever that might have been, the level 1, 2, or 3, and any transfers between levels. For levels 2 and 3, we need a detailed description as well as the significant inputs that go into determining a 2 and a 3. And then furthermore, for the most subjective level, level 3, we need the list of or discussion around the significant unobservable inputs and interest rates. I'm just thinking now off the top of my head, Alvin and I've dealt with quite a few of late. If it was, for example, contingent consideration, we would have the profit estimates that go into that. And then obviously the discount rate in bringing that back to a PV. we would need to show the recon of that level 3 opening to closing balance, and then any sensitivity disclosures. Now, the sensitivity disclosures are posing a bit of an issue because people just simply saying we're sensitive to the discount rate. Well, that's super. How sensitive? So then they go in and they give a blanket, oh, well, a 10% change up or down will result in X and Y. Well, is 10% actually a reasonable change in this? So if we look at, for example, contingent consideration, and we look at the change of profitability, well, is a blanket approach really possible? Is a 10% increase and a 5% decrease not more likely a scenario? Sensitivity remains an issue no matter what we are dealing with when it comes to sensitivity disclosure in full IFRS. Issuers have maintained, so these are just some comments that the JSE shared with us, the fair value derived by an independent valuer, and therefore it must be correct. So we don't need to include all these quantitative disclosures. IFRS 13 disclosure, however, is not driven by who did it. It's driven by the fair value hierarchy. In other words, it's driven by the actual inputs that we use. Whether we use them, whether it be director, a valuer, a 5-year-old, it doesn't matter. The question that's got to be the most pertinent is, what level are we on based on the inputs used? So if they're quoted, unobservable or observable, wherever the mix lies, drives your fair value disclosures that are required. So going back to this pyramid, the higher up you are, the less you're likely to talk about it, but there are still requirements, as we mentioned, even if you're level 1. The lower down in the hierarchy we go, the more prescriptive the disclosures become. The JSE observed in terms of qualitative data that too aggregated is not useful, specifically addressing from an investment property point of view. So if you look at an investment property entity, they've got a massive portfolio, simply saying that, our discount rate ranges between 8 and 12. Well, which part of the portfolio is on 8 and which part of the portfolio is on 12? There are a variety of different examples that the JSE addressed, and that will be seen. Obviously, it is observable in their report back. I didn't want to give too much information here, specifically because we don't have necessarily investment property entities only diving in. The objective of quantitative disclosure is not to enable users to repeat the entity's model, but to provide enough information for the user to assess whether the entity's views indeed differ from their own. So if you're not giving someone enough information to actually get as close as damn it to your pricing, your fair value, well, then the question remains, especially if it's subjective in terms of a level 3, then the question remains as to whether you've met the disclosure objective. Then there's a question around competitive harm, and the JSE just said by no means is this considered a defendable position. So, we don't want to share. That's the board addressed that very clearly in IFRS 8 and said competitive harm is inappropriate. It leads to broad non-compliance arguments. And at the end of the day, most competitors in your industry will have the information that you think is so top secret. At the end of the day, you likely have information about them. So competitive harm is not a defendable position. I just wanted to mention some fair value disclosure requirements: biological assets, investment property, investments, contingent, forward exchange contracts. All of these things might seem quite obvious. I've dealt recently with quite a bit of farming requirements. So if farmers are on Ifrs for SMEs, IS1 categorically deals with, IS41, deals with fair value. And our disclosures need to be sound in terms of obviously, bearer plants, livestock, you name it. Investment property, fairly obvious. Investments, we see investments in subsidiaries in some cases being measured at fair value, quite interestingly. And the requirements for that disclosure needs to be met. It needs to be clear. They also address judgments and estimates being boilerplate, not specific to the entity. It's unclear what the judgment is and where the information is included. Now, I appreciate that maybe a lot of entities utilize, for example, DraftWorks, a template situation. However, the onus is not on the likes of a DraftWorks or the other competitor, but rather on the actual preparer. So we've also got to be careful what it is that we, where we put the blame for things not being included. I mean, ultimately, we can always address, and I'm always happy to assist the team at DraftWorks, if we want to develop a section that specifically addresses judgments and estimates. It is becoming the crux of so much in Ifrs. We think about 16 and the lease term. We think about Ifrs 10 and whether we do or don't control. We look at the expected credit losses. It is never ending as to how much we need to now talk about the judgments and estimates. And sadly, the jargon or the basic paragraph is included. It's either early on in the policies or it's later on in a separate note altogether. And it's so blah because it's just how we've always done it. It's also there in terms of provisions, for example. And often I see one on for provisions in judgments and the estimates that goes into the provision, and then the entity doesn't even have a provision. So it really does come down to this boilerplate stuff. So what the JSC has suggested is perhaps ask yourself, why are we making this decision / including this disclosure? And based on what we have decided, is our reasoning around this judgment actually clear? So I'll see something, for example, that we have judged whether we control our entities, our subsidiaries, our investees. And then nowhere is there actually a conclusive answer as to why was there any judgments. I mean, if you own 80% and you have the voting rights and there's nothing to say that there's something deviating in terms of de facto control or something, equally arbitrary, where's the judgment? And that's where I think we miss it. So we switch it on just in case, but indeed there wasn't one. Both judgments and estimates support the actual underlying of financial statements. And this was addressed in an educational material number 3 that was issued by SICA in April 2020. So SICA actually entered into a series of educational material that they pumped out during the early stages of the pandemic. So by all means, please, utilize this educational material as far as possible. It does tell us that we need the necessary disclosures as reiterated in these paragraphs. The questions, these are helpful, and this is pretty much the last thing I'm going to discuss before I finish with going concern. So if we have judgment, ask yourself 3 things. What were the alternatives? And have I told the user what the alternatives were? Have I explained why it was difficult / why judgment was involved? And then have I explained why I chose B over A or whatever the case might be? That's a judgment disclosure. On the other hand, when we get to estimation and assumptions, have we identified the assumptions? Did we prioritize the quantifiable disclosures as much as possible? So did we give as much as we could relating to these assumptions, whether they be the relevant inputs? Think about your goodwill calculation. Did we talk about the sensitivity? Now this one is huge because sensitivity in any kind of an input calculation would result in a very different answer, depending on how sensitive the information is. And then lastly, identifying the most likely view, or if it's a probability-based outcome situation, and providing all of that disclosure is what is required in terms of IS1. We saw the JSE address an example of good COVID-19 disclosure. I was able to derive, this is not the picture that the JSE used. I was able to determine that it was indeed Telkom that they used as an example. This here is really just an illustration of what they put in as part of their judgments and estimation. What was cool is putting it in a table, discussing the potential impact depending on the topic. So here was 16, here was your ECLs and the subsequent events or events after the reporting date. And then they also gave the note reference. So you were able to go and see in note 26, for example, what the impact was and how this assessment tied into whatever was presented as part of that note. Very cool. Alvin and I did stuff quite similar with most of our entities. And it does present a very holistic view, especially in light of a lot of entities and audit firms having like a COVID-19 panel. Last but not least, ladies and gents, this part of the session when the JSE presented was presented by Professor Ahmed Haji from the University of Johannesburg, brain mouth, sorry. Helpful disclosure in terms of going concern. They addressed a couple of things. The next two slides, just to mention, also talk about talk about COVID-19 disclosure, and will be quite helpful for you to go and look at, well, what have we or what should we be looking at? Has COVID-19 affected it, yes or no? And how deep should we go? On the going concern, that's been a big issue. I took this picture from his slide actually. So he highlights, were there any material uncertainties? What was the period on which the going concern assessment covers? What are the different scenarios being considered? And how does COVID-19 impact those? The yellow indicate the inputs that have been subject to stress testing, explaining how the stress test affected the conclusions. Identify and explain any mitigating actions the board could take. Alvin and I requested this on a specific entity, what the board could do to improve liquidity. So in other words, if something were to happen, do we have enough cash? Would we go straight for a capital raise? Is that even an option? To explain any changes after the reporting date, whether that be extension of facilities, renegotiation of bank covenants, or perhaps waiving them. The level of drawn and undrawn facilities in place. And what are the covenants? Do we expect to breach those? How far are we from breaching? And what happens if we do breach? This here, myself and Alvin have incorporated as part of the capital management note, which is where we see the ratios, so your debt to equity ratio, etc., of the entity. Very useful in also just taking a look at around this explanation of liquidity risk and sources of finance. So if we were to incorporate everything around the finance structure of the entity, how that plays a role in our capital management, what is our debt to equity ratio, because all these things are obviously required in terms of IS1 anyway. But the JSE took it obviously a step further and said, well, why don't we, just tell our users, especially if there is a problem. I think on that note, like I said, there's also the covenant breaches on the next one. So I think there's a lot of useful stuff that comes out of some JSE documents, even if you're not listed, and even if you're on SME. So I would really implore that we all just consider that we're not in boxes in terms of an SME's framework versus an Ifrs framework, and that there are so many documents, so many publications at our disposal to not only improve by ticking boxes, but really improve the financial statements and what they're saying as a holistic story in light of where we actually are. I often find that it's very much a tick box exercise. Closing comments from the JSE were, does it communicate the information that the users need? And that's really the spirit on which I want to end. And look at all your financial statements. Are we simply getting them done because it's a job? I don't know. It's the audit. It's what we've got to do. Or does it actually present the information required? I get a one-horse, entity, different story, an owner-managed situation. The only people interested there are the bank and SARS. In terms of the disclosures, it's specific to the entity or an asset group or perhaps a key operation. And this here being the overarching for me. Avoid disclosing something just for the sake of it, just simply because it ticks the box. We really have to move to a point of relevance. Please note I'm saying relevance, not materiality, because that's always a bit of a danger zone. I do appreciate you, for those of you that have stayed on, that have benefited in some way, shape, or form, even if it has just been a bit of not intended to be a scare tactic, but more an awareness of where are we at, specifically Ifrs for SMEs, and where are we now from an Ifrs 16 point of view. It really isn't a situation where we're all done and dusted simply because we're done with transition. I thank you for your time. I hope that you've that you've at least gained some insight into some of these aspects, and that we will hopefully host another one, if nothing else, on Ifrs for SMEs once we get an exposure draft, perhaps clarifying what exactly it is that we're going to be facing. On that note, Al, I don't know if you want to also just say thanks. I want to thank you, Al, specifically for dealing with all these questions in the background. I know that that's not an easy feat. And then in addition, also, Earl and your team for hosting us yet again. It's a privilege and a pleasure. Thank you so much.
Absolute pleasure to have you as always, Kim and Alvin. Thank you so much. I'm sure everybody learned something new, and look forward to the next time.
Hopefully sooner rather than later.
Yeah, definitely.
Keep safe and keep warm and all that. I see that I've just received a notification that we're going on to load shedding. I have a different word for load shedding. It's more like load shitting. My apologies. We're going on.
I'll edit it out, don't worry.
Yeah, we're going on at 5 again. So everyone go and do your necessary, your planning, and take care in the fullness. Everyone keep well throughout our third wave. Thanks again, Al, for all your help in the background. I appreciate it.
You want to pop up your contact details, and then we can.
It'll be in the slides if that's okay. So everybody can just pop it in on.
Perfect.
It is on slide 2. So feel free, if you do need to get hold of either Alvin or myself, you know where to find us anytime, and we're happy to engage. Okay, great.
Just to reiterate, guys, the video will go up tonight. There'll be links in the video for the notes downloads. And then we'll also send the notes and CPD out probably towards the end of the week or early next week. That will all be done. Okay. So
thanks, Earl. Take care, everyone.
Thanks, everyone. Enjoy the rest of your day. Hopefully we see everybody for the new DraftWorks features on the 22nd of June, Tuesday. It's going to be showing you some great new things. So please register for that. We'll send out a reminder mail about that too. Enjoy the rest of your day, everybody. Take care.
Cheers. Bye.